You get an email from your landlord. Dear tenant, due to market conditions, your rent will increase by $150 starting next month. You sit there staring at the screen. Didn't it already go up last year? Your salary barely moved. Groceries cost more. Energy bills are higher. Insurance went up again. And somehow, the same apartment you were already struggling to afford now costs even more. It feels personal, but it isn't. It feels random, but it's not. There is a hidden system quietly operating in the background that almost guarantees your rent keeps rising over time. And almost nobody ever explains this system clearly. Once you see how it actually works, rent increases stop feeling mysterious. They're not temporary, and they're not accidental. They're the predictable outcome of rules, incentives, and math most people never see. Today, we're going to open that system up and look at it directly. We're usually given a very simple story about rent. Rents rise because of supply and demand. More people, not enough homes, prices go up. End of explanation. That's what politicians repeat. That's what headlines say. That's what real estate agents tell you. But if that were the full story, rent would sometimes go down. Because sometimes populations shrink. Sometimes new housing gets built. Sometimes economic conditions soften. And yet, even in cities where populations are flat or falling, rent somehow keeps creeping higher. Over the last few decades in many developed countries, average rents have risen roughly 2 to 3 times faster than average wages. So either millions of workers suddenly became terrible at negotiating pay, or something structural is happening beneath the surface. It's the second one. And to understand it, we have to stop thinking about rent as just the price of a place to live. Most people think rent is one simple thing, a monthly payment for shelter. But in reality, rent is 3 things at once: a housing payment, an investment return for someone else, and a hedge against inflation. That third one is the key most renters never see. Because once rent becomes a financial product, not just a roof, different rules apply. So let's ground this with a simple example. Imagine a landlord buys an apartment for $300,000. They put down $60,000 and borrow $240,000 from the bank. Their mortgage payment is $1,400 a month. They rent the apartment to you for $1,800. From your perspective, you're paying $1,800 for somewhere to live. From their perspective, $1,400 goes to the bank, $200 goes to taxes, insurance, and maintenance. $200 is profit. So far, that seems straightforward. Now fast forward 1 year. Inflation is 5%. Repairs cost more, insurance costs more, property taxes rise. But the mortgage payment is still $1,400. So what happens? They raise your rent to $1,900. Not because they suddenly became greedy, but because the structure quietly pushes them to. If they don't raise the rent, their real return goes down. If they do raise it and you stay, the system learns it can extract more without breaking. Here's the part almost nobody explains. Rent is not primarily driven by tenants. It's driven by debt. Almost every rental property has one thing in common: a mortgage attached to it. And mortgages create powerful incentives. When interest rates rise, landlords say, "My costs went up, so rent must rise." When interest rates fall, landlords say, "Great, I can borrow more." Cheaper borrowing pushes property prices higher. Higher prices justify higher rents. Either way, the tenant pays more. Rising rates mean higher rents. Falling rates mean higher prices, which still mean higher rents. Inflation means higher rents. There are very few scenarios inside the current system where rent naturally falls for long. If it does dip, it tends to bounce back quickly. That's not a mistake. It's design. This is what a debt-driven asset system looks like. Housing is not priced for living. It's priced to service loans and grow balance sheets. We like to imagine rent is set by fairness. It isn't. Rent isn't set at what's reasonable. It's set at the maximum a working person can tolerate before they're forced to move. And over time, that limit rises. Housing is not a normal product. You can delay a new phone. You can skip a vacation. You can cancel streaming services. You cannot skip having a roof. Economists call this inelastic demand. That's why people in many major cities now spend 40, 50, even 60% of their income just to keep a key and a front door. In the 1970s, the typical household spent closer to 25%. Your apartment didn't get twice as good. The system just learned it could squeeze harder, slowly, predictably, and legally. Once you see rent as a system instead of a bill, something becomes obvious. When rent rises, three groups quietly benefit. Landlords benefit from higher values and cash flow. Banks benefit from larger loans and more interest. Governments benefit from rising property taxes and rental income. The only group that doesn't benefit is the person paying the rent. High rent isn't a failure of the system. It's one of its core features. Every few years, the same solution gets repeated. We just need to build more housing. And that sounds logical. But most new housing isn't built to be affordable. It's built to maximize return per square foot. Luxury units, premium finishes, higher rents. So supply increases, but prices don't fall the way people expect. Add financialization. More housing is owned by funds, REITs, and institutions. For them, rent is a spreadsheet variable. If it can rise 5% a year and tenants stay, that becomes the new standard, and it spreads across the market. There's also a psychological trap. Moving is painful. Deposits, costs, paperwork, risk. So most people stay even when rent rises. And year by year, the bar inches higher. Rent both feeds inflation and is justified by it. When money is printed or rates are cut, a large portion flows into assets, especially real estate. And when real estate prices rise, rent follows. People say, this is why you should just buy. But most renters don't rent by choice. Prices are inflated. Deposits are high. Credit is tight. Wages haven't kept up. The system makes ownership harder while making renting more expensive. That's the squeeze. Run the math. A $1,600 rent rising 5% becomes over $2,000 in 5 years, $2,600 in 10, and over $3,300 in 15. If income grows slower than rent, the gap widens every single year. Not because you're failing, but because the formula is designed that way. The modern economy quietly relies on renters staying renters. Because renters create predictable cash flow for property owners, banks, investment funds, and pension systems. Your rent check isn't accidental. It's someone else's retirement strategy. Not through conspiracy, through incentives. So what can you do? You can't rewrite housing policy overnight, but you can stop being the easiest person to extract from. Negotiate more than you think. Know your local market. Build flexibility where you can. Treat renting as temporary by design. Separate your identity from your zip code. The goal isn't buying tomorrow, it's optionality. Because options weaken the system's grip on you. Rising rent isn't proof you're failing. It's proof the system is working exactly as designed. Once you see that clearly, you stop blaming yourself and start asking a better question. What game am I actually playing? This channel exists to explain the system shaping your money, your housing, and your future, without hype and without fake solutions. If this helped you see rent differently, subscribe, because understanding the system is the first step toward beating it.